Imagine you wake up tomorrow morning and check your bank account. The number is still there, your savings haven't vanished, but when you try to buy something, anything imported from outside the United States, the price has doubled. Not because of a stock market crash, not because of inflation you can see on the news, but because overnight the currency you've spent your entire life trusting, the dollar, quietly lost half its purchasing power on the global stage. This isn't some dystopian fantasy. The mechanism for this already exists. It was signed on November 15th, 2022, in Bali, Indonesia. While CNN led with inflation headlines and Fox debated midterm elections, 20 world leaders gathered at the G20 Summit and signed a declaration. 52 paragraphs of diplomatic language. Paragraph 27 changed everything. It committed governments to making central bank digital currencies interoperable for cross-border payments. Technical, bureaucratic, forgettable. Markets barely moved. But buried in that language was the blueprint for payment infrastructure that could process $150 trillion in annual global trade without touching the US dollar, not compete with it, not challenge it, bypass it completely. The meeting nobody watched just might be the meeting that ended 80 years of American financial dominance, and you're about to find out how. The official narrative was perfectly benign: enhancing cross-border payments, supporting financial inclusion, exploring central bank digital currencies for the modern era. The Bank for International Settlements, the central bank of central banks, presented their report on interlinking payment systems and the role of application programming interfaces. Finance ministers nodded politely. The language was so technical, so bureaucratic, so thoroughly designed to induce sleep that nobody bothered to read between the lines. And that was precisely the point. Because while the world was distracted by inflation rates and midterm elections, something extraordinary was happening in the data. By 2024, 91% of the world's central banks, 85 out of 93 surveyed institutions, were actively exploring either retail or wholesale CBDCs. The BIS Innovation Hub's Project Enbridge had already reached what engineers call minimum viable product stage. It wasn't theoretical anymore. It was processing real transactions between the central banks of China, Thailand, the United Arab Emirates, Hong Kong, and Saudi Arabia. Let that sink in for a moment. Saudi Arabia. The nation that underwrote dollar dominance for 50 years through the petrodollar agreement was now participating in payment infrastructure that functions entirely without dollars, not as a backup plan, not as a hedge, as operational technology processing actual cross-border settlements. The transaction time was 7.2 seconds versus Swift's 3-day processing window. The cost was near zero versus traditional correspondent banking fees of 4.95%. This wasn't competition. This was obsolescence. But here's what makes this moment different from every other prediction of dollar decline you've heard over the past 2 decades. For the first time since Bretton Woods in 1944, the world's major economies weren't just talking about alternatives. They had agreed to build payment infrastructure capable of functioning without the dollar as the bridge currency. China's CIPS system, the cross-border interbank payment system, processed $24.47 trillion in 2024. That's a 43% increase from the previous year. Russia and China were conducting 95% of their $245 billion in bilateral trade using rubles and yuan. No dollars involved, no SWIFT messages required. BRICS nations as a bloc settled 65% of their internal trade in local currencies by 2024. You need to understand what this represents. The dollar didn't become the world's reserve currency because America won World War II, though that helped. It became dominant because it was the most efficient mechanism for settling trade between nations that didn't trust each other. Japan doesn't trust China, Germany doesn't trust Russia, Saudi Arabia doesn't trust Iran. But they all trusted dollars because dollars meant access to American capital markets, property rights enforcement, and a legal system that wouldn't arbitrarily freeze their assets. Except that last part stopped being true, and that's when the entire system began to crack. Between November 2022 and August 2023, while the Federal Reserve raised interest rates 7 times and Europe battled an energy crisis that threatened to collapse its industrial base, a different financial architecture was being assembled in plain sight. Not announced with fanfare, not debated in parliaments, constructed quietly, methodically, one technical integration at a time. China's CIPS system wasn't just growing, it was metastasizing across the global financial network. From 1,427 financial institutions in 109 countries in 2022 to 1,690 participants spanning 121 countries by 2025. Daily transaction volume hit $90.95 billion. The system was processing 30,500 transactions per day with 99.999% availability. That's not experimental infrastructure. That's professional-grade reliability on par with any Western payment system. But here's the mechanism most analysts completely missed. CIPS still relies on SWIFT for 80% of its messaging infrastructure. It uses the same ISO 20022 standards, the same technical protocols, the same communication backbone. On the surface, this looks like dependency, like CIPS can't function without Western infrastructure. Except that's not what's happening. CIPS isn't trying to replace SWIFT. It's hollowing it out from within. Think of it like a parasite that uses the host's circulatory system until it's strong enough to survive independently. Every transaction that runs through CIPS, even if it uses SWIFT messaging, is a transaction settled in yuan rather than dollars. The infrastructure looks the same, the outcome is fundamentally different. And then there's Project mBridge, which did something genuinely revolutionary. It created a multilateral CBDC platform where central banks could transact directly with each other. No intermediary, no correspondent banks, no SWIFT messaging, no dollars serving as the bridge currency between mismatched trading partners. Just central bank to central bank transfer using digital currencies on a distributed ledger. By October 2024, 32 central banks were observing members of the project, including institutions you wouldn't expect. The Reserve Bank of Australia, the Bank of Korea. These aren't rogue states trying to undermine the dollar. These are American allies quietly building the capacity to function without it. Meanwhile, Russia's desperation became innovation. After Western sanctions excluded Russian banks from SWIFT in 2022, Moscow's SPFS system went from backup plan to critical infrastructure overnight. By 2024, it had connected with payment systems in China, Iran, and India. Russia-China bilateral trade hit $245 billion annually, with 95% settled in rubles and yuan. But the real revelation came at the Kazan Summit in October 2024. Russia unveiled BRICS Pay, not a currency, not a blockchain token, a settlement layer, QR code-based, blockchain-enabled, connecting existing payment systems across member states without requiring anyone to create a single new currency or abandon their own monetary sovereignty. And it wasn't vaporware. Tourists in Russia could already use it to pay for goods via existing bank cards from their home countries, bypassing dollar conversion entirely. This is what infiltration looks like. India's UPI system processing 357 billion transactions domestically. Brazil's PIX handling instant payments for its entire population. The UAE bringing sophisticated financial infrastructure and its position as the fourth largest gold trading center globally. And Saudi Arabia, the petrostate that underwrote dollar dominance for half a century, joining mBridge as a full participant. The 15th BRICS Summit in Johannesburg in August 2023 was supposed to be ceremonial, a photo opportunity, another round of communiques about cooperation and shared values that wouldn't amount to anything concrete. Instead, it became the inflection point where aspirational rhetoric transformed into operational infrastructure. Argentina, Egypt, Ethiopia, Saudi Arabia, Iran, and the United Arab Emirates received invitations to join as full members. By January 2024, 4 had formally joined, with Argentina withdrawing after a change in government. But pay attention to who stayed in: Saudi Arabia and the UAE, the two nations that control the flow of petrodollars, the very mechanism that has sustained dollar demand for 50 years. Here's why this mattered in ways that most coverage completely missed. For half a century, the global economy ran on a simple loop. Oil flows one direction, dollars flow back. Those dollars get recycled into US treasuries. That demand for treasuries keeps American interest rates artificially low. Those low rates allow the United States to run deficits that would bankrupt any other nation. The entire architecture of American economic dominance rests on this recycling mechanism, and now the countries controlling that mechanism were openly discussing alternatives to the dollar-based oil payment system and their openness to using the petroyuan for oil settlements. This wasn't theoretical anymore, it was operational. Chinese yuan-denominated oil futures were already trading on the Shanghai International Energy Exchange. The infrastructure existed. All that remained was the political decision to use it at scale. While headlines obsessed over whether BRICS would create a single currency to rival the dollar, which was never realistic and never the plan, the real action was happening in bilateral currency swap agreements. China had established swap lines with over 40 central banks. India and the UAE launched their local currency settlement system. Iran and Russia built payment corridors that functioned entirely outside Western oversight. Brazil and China agreed to conduct their $150 billion in annual bilateral trade through direct yuan-real settlement, bypassing the dollar completely. By 2024, China's yuan-denominated cross-border lending hit 32% of its total, up from just 17% in 2021. The yuan reached 8.5% of global foreign exchange trades by September 2025, still small compared to the dollar's dominance, but accelerating at a pace that should terrify anyone paying attention. The New Development Bank, which started as little more than a BRICS political project, had approved 120 investment projects totaling $40 billion. Increasingly, those projects were denominated in local currencies rather than dollars. Egypt, the UAE, and Bangladesh joined as members. The bank was proving a concept that Western economists insisted was impossible. You can finance major infrastructure without dollar-denominated debt. You can operate a multilateral development institution without Washington's approval. You can build an alternative to the Bretton Woods system that actually works. And then came the Johannesburg Declaration itself. Buried in the diplomatic language was a directive. Finance ministers and central bank governors were tasked with identifying options for increasing the use of local currencies in trade between member states. Translation: build the payment rails now, announce the policy shift later. By October 2024 at the Kazan Summit they delivered the interbank cooperation mechanism, preliminary BRICS Pay functionality, discussions on cross-border settlement frameworks and reinsurance capacity. These weren't aspirations anymore, they were deliverables, operational systems processing real money for real trade. October 22nd through 24th, 2024, Kazan, Russia. The 16th BRICS Summit accomplished what Western analysts insisted was impossible. Over 30 delegations attended. 22 heads of state showed up in person. The United Nations Secretary-General Antonio Guterres was there, lending institutional legitimacy to a gathering that was supposed to represent isolated pariah states. All of this while Russia remained under the most comprehensive sanctions regime ever imposed on a major economy. The optics alone shattered the isolation narrative that Western media had been pushing for 2 years, but the substance was far more significant than the symbolism. 7 days after the summit concluded, the Bank for International Settlements made an announcement that barely registered in Western financial press. The BIS was withdrawing from Project Enbridge and handing operational control to the participating central banks. BIS General Manager Agustin Carstens insisted the timing was purely coincidental. Enbridge is not the BRICS bridge, he said. The project was mature enough to transition to independent operation. The denial was more revealing than any admission could have been. The BIS, the most powerful financial institution you've never heard of, the coordinator of central bank policy for 95% of world GDP, could not afford to be publicly associated with infrastructure that was transparently designed to circumvent Western sanctions. So they did what any institution does when plausible deniability becomes impossible. They handed it off to someone else and walked away. And then China open-sourced the Enbridge software, making it available for any central bank in the world to implement. At the Moscow BRICS Business Forum preceding the Kazan Summit, BRICS Pay went operational for consumer-to-business transactions. Tourists in Russia could pay merchants using QR codes linked to their home country bank cards without opening local accounts, without currency conversion fees, without touching the dollar. The business-to-business functionality for trade settlements was still in development, but the consumer infrastructure was already deployed and functioning. This wasn't a press release about future capabilities. This was working technology processing real transactions. The Kazan Declaration itself ran 32 pages covering everything from UN Security Council reform to biodiversity conservation. But paragraph by paragraph, the economic commitments built a blueprint for post-dollar trade. Strengthening BRICS interbank connectivity, promotion of local currency settlement mechanisms, development of a voluntary and non-binding BRICS cross-border payment initiative, building independent reinsurance capacity to reduce dependence on Western insurance markets. The language was careful, voluntary, non-binding. Yet every member state committed their finance ministers to report concrete progress at the next summit. And then came the expansion that changed the strategic calculus entirely. 13 new partner countries joined the BRICS framework: Algeria, Belarus, Bolivia, Cuba, Indonesia, Kazakhstan, Malaysia, Nigeria, Thailand, Turkey, Uganda, Uzbekistan, and Vietnam. Not full members. A new tier of association that allowed participation without full commitment. Look at what that list represents. Nigeria, Algeria, and Uganda gave the bloc critical mass in Africa, the continent with the world's fastest growing population, and most of the planet's tapped mineral resources. Malaysia, Thailand, and Indonesia brought Southeast Asia into the fold, and Turkey, a NATO member, attending a BRICS summit, applying for partnership status. The Cold War binary of East versus West had officially dissolved into something far more complex and far more threatening to American financial dominance. 1 month later, President-elect Donald Trump posted on social media, "We require a commitment from these countries that they will neither create a new BRICS currency nor back any other currency to replace the mighty US dollar, or they will face 100% tariffs." The threat itself was the tell. If this wasn't a real challenge to dollar hegemony, it wouldn't merit a response from an incoming American president. So what does this mean for you? Not for geopolitical strategists or central bankers, but for you personally, checking your bank account on your phone, planning your retirement, trying to figure out if your savings will be worth anything in 20 years. If you're over 65, you remember when made in Japan meant cheap. Then it meant quality. Now it's made in China. That shift happened because payment systems evolved to accommodate new manufacturing centers. What's happening right now is bigger. The US dollar accounted for 80% of global trade settlement and 88% of foreign exchange transactions for decades. By early 2025, it's 50.2% of SWIFT transactions. Still dominant, yes, but the trajectory is unmistakable, and every single percentage point represents roughly $500 billion in annual transaction flow moving to alternative systems. Here's what that means in practical terms. The dollar's reserve currency status has allowed the United States to run deficits that would destroy any other nation. $1 trillion in annual deficit spending, $35 trillion in total debt. This is sustainable only because foreign countries need dollars for trade, so they buy treasuries to store those dollars, which finances American government spending. That recycling mechanism has kept interest rates artificially low for your mortgage, your car loan, your credit cards. It's subsidized American consumption for 80 years. If even 20% of global trade shifts to local currency settlement over the next decade, treasury demand drops, interest rates rise, deficits become more expensive. The exorbitant privilege that let America live beyond its means since World War II begins to erode. And there's another mechanism you need to understand. The dollar's strength has been inversely correlated with commodity prices for decades. When the dollar is strong, commodities priced in dollars appear cheap. When it weakens, they appear expensive. As de-dollarization accelerates and commodities get repriced in yuan, rupees, or basket currencies, they become relatively more expensive in dollar terms. That's inflation, not from the Federal Reserve printing money, though they've done plenty of that, but from reduced global demand for dollars making each dollar less valuable in purchasing real goods. Central banks globally have doubled their gold purchases over the past 5 years. China's reserves hit 2,264.87 tons in the first quarter of 2024. They're not buying gold because they love shiny metal. They're buying it because they don't trust a system where one country controls the payment infrastructure and can freeze your assets with the stroke of a pen. The system built at Bretton Woods in 1944 gave America financial hegemony because Europe and Asia were in ruins. That's not the world anymore. BRICS nations represent 40.2% of global GDP by purchasing power parity, surpassing the G7's 28.8%. BRICS merchandise exports hit 27.3% of the global share in 2024. The G7 sits at 28.1%. Essentially, parity. This isn't a challenge to American power. This is the end of American monetary monopoly, and that changes everything about how the next generation will experience economic reality compared to everything you've known your entire life.